Welcome back. So today we're digging into an analysis report on Applied Digital Corp, or APLD. As I see it, the piece frames a recent 5.43% drop in the stock as this golden entry point for investors, all based on the company's big pivot into AI infrastructure.
Right, and some pretty high analyst price targets.
Exactly. So let's just get right to it. The first big opportunity here starts with the tone. The framing of the thesis, it leans really heavily on this hyperbolic urgency.
Okay.
And I think that might unintentionally undermine the really strong fundamental case that's presented later on. It uses phrases like crash alert, nosedive, and talks about panic sellers.
Yeah.
All to describe what is, a pretty standard 5.43% single-day pullback for a stock like this. The language is just, it's intense.
And I get it. I mean, the goal is obviously to grab your attention immediately. That kind of language, that sensationalism, is super effective for a hook.
For sure.
But you have to ask about the trade-off. Is that initial jolt worth, potentially losing some credibility down the line? The weakness here is really the misalignment.
Misalignment between what?
Between the language and the actual scale of the event. Calling a 5% pullback a crash, it sort of suggests an emotional reaction, not an analytical one. And that matters, because the target audience for this kind of deep dive, we're talking about their HPC pivot, their 84% revenue growth. That audience is likely pretty sophisticated.
The smart money, so to speak.
Exactly.
Okay, but let's be real for a second. In today's financial media landscape, isn't crash alert just necessary? Is that sort of financial sobriety you're talking about worth it if no one even clicks on the report in the first place?
That's the tension, right? But it all depends on the ultimate goal. If the goal is just clicks, yeah, the hyperbole works. But if the goal is to convince serious investors, institutional or just well-informed individuals to actually act on the research, then the rigor has to win. You risk those informed investors just dismissing the whole thing as noise before they even get to the good stuff, the fundamental data. The conviction should come from the data, not from, alarm sirens.
So the fix is to find a middle ground. Keep the energy of the opportunity, but lose the language of a disaster.
That's it, exactly. The suggestion here is to recalibrate the urgency. Emphasize the magnitude of the opportunity the dip creates, not the severity of the dip itself. Let the facts about AI infrastructure do the heavy lifting.
Okay, so let's make that actionable. How do you actually adjust the presentation without losing that immediate punch?
Well, you hit two main areas. First, the title. Instead of something that screams panic, you frame it around the investment thesis. So you replace APMLD crash alert, why this 5% drop is a gift for investors, with something like Applied Digital, why this consolidation makes the AI infrastructure case stronger.
Right. It's still urgent, but it's strategic. It tells me this is a serious piece of analysis right away.
It does. And then you adjust the hook, the emotional language. Instead of fear, you frame it with strategic patience. The report says the panic sellers are out. A much stronger way to put that would be to focus on the transfer of shares. Something like, the weak hands are shaking out, creating the sharpest entry point we've seen this quarter. That immediately upgrades the sophistication.
I like that. It reframes the author from a cheerleader to a strategic buyer with a plan. Okay, let's move on. The second major opportunity here is about balance, which is just critical for trust.
Absolutely.
The report does a brilliant job detailing the upside, that potential 100% gain to the $60 target. But the risk-to-reward section feels, well, incomplete. It's very minimalist on the downside.
How so?
It calls the risk-to-reward absolutely beautiful, which is great for building excitement, but then the entire downside is addressed in a single, almost dismissive phrase. The downside? Maybe we test $28. That just feels like a stark imbalance.
Yeah, and that is the exact structural flaw we need to fix. If you're arguing for massive upside, you have to be just as rigorous on the other side of the equation.
Otherwise, it feels like you haven't really stress-tested your own idea.
You haven't. And for analysis to be credible, especially to a sharp audience, you have to talk about the failure points. What could make this whole bullish idea fall apart? Not just a small drop. When you don't expand on what breaking $28 actually means, it leaves a huge analytical gap. It suggests promotion over analysis.
Okay, but here's a practical concern. If you dedicate a whole section to the bear case, aren't you risking, diluting the bullish conviction you're trying to build? Don't you risk the audience just fixating on the negatives?
That's a finger point. But I'd argue it does the opposite. A good risk section doesn't dilute conviction, it validates it. It shows you've already considered the counterarguments and found them lacking. A confident analyst tells you why they're right, but they also tell you exactly what would prove them wrong.
That allows for disciplined risk management.
Exactly. So the suggestion is to really strengthen that risk assessment, outline the bearish counterarguments, detail what specific scenarios would kill the bull case.
So how do they do that? How do you build a serious bear case while keeping the focus on APLD's strengths?
Well, you have to tie it directly to the core thesis. APLD's value is all about scaling its AI infrastructure, right? So the bear case has to hit that. You could add a section called Key Risks and Failure Points.
Okay.
And in it, you'd ask, what if HPC demand cools faster than we expect? That's the main driver. If it falters, the story breaks. Or what about operational risk? What if data center build-out costs just escalate and kill their margins? Or competition. What if a giant like NVIDIA starts to vertically integrate and makes APLD less essential?
Perfect.
Addressing those complex questions shows you've done homework way beyond just looking at a price chart.
And what about that $28 price point? How do we make that more than just a casual number? You have to give it structural meaning. So instead of just saying, maybe we test $28, the report should specify the implications. For example, you could say, if APLD fails to hold $28 for 3 consecutive closes, that suggests a structural change in the pattern, requiring a reevaluation of the entire long-term trend. That turns it into a measurable, objective line in the sand.
A point of no return.
That really enhances the integrity. Okay, which brings us perfectly to the next point, which is tied directly to those price levels. Specifically, the justification for that $30 golden entry point. The analysis relies heavily on calling $30 a critical psychological support level. It makes holding that line the linchpin of the whole short-term idea. But it never really proves why it's so significant beyond just being a round number.
Yeah. And that's a common trap. It's almost a market superstition. In professional analysis, just calling a round number psychological support is, well, it's pretty weak, especially when you're calling it the definitive entry point.
Right. Why is this specific drop to $39.99 the big opportunity and not, say, $29 or $28 or $25?
Exactly. The analysis doesn't tie the $30 level to any real technicals. No historical price action, no major moving averages, no Fibonacci levels, nothing. And without that evidence, the entry point just feels arbitrary. And sophisticated investors can smell arbitrary a mile away.
So you have this fantastic fundamental bull case, but it's sitting on a technically flimsy argument for the timing of the trade. You got it. The suggestion then is pretty straightforward. Integrate specific, measurable technical data to validate that $30 support level. Transform it from just an observation into a robust technical argument. So you mentioned things like a 50-day moving average or prior resistance. Why lean on those simpler indicators? Why not something more complex, like an Elliott wave count or a volume profile analysis?
That's a great question. For a high-confidence, near-term entry, simple and widely followed indicators are often way more effective.
Why is that?
Because they're almost self-fulfilling. They represent areas where the most market participants are already looking to place their bids and offers. The 200-day is too slow for a short-term entry, and more complex theories can introduce too much subjectivity. You want clear, objective levels.
So give me a concrete example. How could they connect $30 to the chart history?
Okay, so they could connect it to moving averages. They could add a line that says, the $30 price point is critical because it aligns precisely with the 50-day exponential moving average, suggesting this is a natural retest point before the next leg up.
Okay, that gives an objective reason for why the pullback might stop here. What about past trading patterns? Right, or you could connect it to past structure. This is a classic. The report could say something like, we should recognize that $30 served as a significant resistance ceiling during the Q3 consolidation. Now that it's being tested from above, it should ideally act as strong support, a textbook technical flip. That's a powerful visual. Resistance becomes support. It elevates the whole argument.
It does. And it gives the investor confidence that the entry isn't just random. It's